Very good evening to all the participants on the Zoom platform and also on the live link. May I request the participants to keep themselves muted consistently. Towards the end, we will have question answers, and at that time, you can specifically unmute yourself so that it is a bit easier to take the entire session and share the knowledge accordingly. It's my pleasure to welcome all of you to this session, and we have had various opportunities to have sessions like this. Of course, technology has helped us in trying to reach out to all of you in a more convenient manner and a more cost-effective manner as well. And the government, of course, has kept on giving us various opportunities by way of very frequent amendments to reach out to you and try to communicate the changes. Because end of the day, one important facet which we always believe is that a well-informed client always results in lesser issues and disputes. And therefore, it's always our priority to keep you updated. We all are aware that there are various means through which we are trying to reach out to you. One is, of course, the periodic newsletters and the flashes. Every month we do send in a newsletter, and as and when the amendments happen, there is a news flash which also is sent to you through the WhatsApp group as well as the email group. We also have recently started the Back to Basics series, wherein we take you through the entire GST legislation and we revisit the basics and understand the entire law through a series of sessions taken by the partners and the senior managers. I'm sure each of you is taking benefits of those sessions and the additional sessions which we keep on doing from time to time, like the current one. The occasion for today's session is twofold. The first reason to meet today is definitely the fact that GST has completed 5 years, and over these 5 years and even before that, in the year immediately preceding the introduction of GST, we have had various extensive meetings and sessions wherein we have talked about how GST has been a landmark reform. And when you look at a 5th anniversary, I think it's time to spend a few minutes understanding what are the hits and misses of GST, especially at the 5th anniversary, and what perhaps could be the way forward on this front. And therefore, what we thought was we'll have one slide which explains or tries to give a perspective to what was the indirect tax structure then. And when we say then, we are talking of 5 years prior to today, before 1st of June to 1st of July 2017, and what we are at this point of time now. And we've tried to just look at 5 or 6 macro issues, and these are all perspectives. Of course, opinions can differ, and each, just like a watch, each watch shows a different time. Each person's opinion may be slightly different, but here we just try to step back for a few minutes and reflect on some of the important aspects at a macro level of how GST has changed the indirect tax landscape, and what does it mean for us as clients who are into businesses, and how does this mean adaptability towards the business processes carried out by an organization. As far as the applicability of tax is concerned, and this is one area which constantly we have been talking and everyone has appreciated this aspect, that GST in a way has been a consolidating act. Prior to GST, we had n number of taxes. We had VAT, service tax, and always, because of that fractured tax regime, we always had a doubt in our mind that whenever a transaction is undertaken, whether it would be liable for VAT, whether it will be liable for excise duty, whether it will be liable for service tax, whether it will be liable for works contract tax. Even when we say it's a sale of goods, there was always a challenge of whether VAT or CST applicable on that. And therefore, because of that fractured tax regime, the first entry point into an indirect tax of when you raise a transaction and when you raise an invoice, what tax should be charged was a challenge 5 years ago. Luckily, with GST, this has been a problem which has been nipped in its bud. Around 14 indirect taxes are now a part of GST. And therefore, today, except for specific products which are outside the levy of GST, like alcohol, petroleum, of course, there are discussions of bringing petroleum into GST at some point of time. But as of today, we do have that a few products like liquor, petroleum, electricity, which are outside the GST. But except those few products which are outside the GST, one thing which is very clear is either there is a GST or there is no tax. So in that sense, the tax applicable has become more or less certain because of the comprehensive coverage. And I think this is, of course, the part of the scheme of GST. And this has, I would believe, the biggest benefit of introduction of GST, which has changed from then to now. Having said that, I will pay GST. Earlier, after identifying a tax, one also had to identify the classification and the tax rates. Classification, of course, kept on varying. In service tax, we had something known as taxable service, and within taxable services, we had service categories. Whereas in excise, we had an HSN classification. VAT also, to a large extent, followed a schedule and an entry mechanism based on HSN classification. But because of this classification and multiplicity of tax rates, we also saw that after identifying a tax applicable, there used to be significant disputes of classification. And because in GST, we are continuing with this HSN classification, we see that some disputes continue. And today, more and more emphasis is kept on HSN classification. For example, even now we are told that in the annual returns to be filed, it will now be compulsory to mention a 6-digit HSN. So, because you are now going into the HSN classification, and into a large extent, the HSN classifications, especially for services and even to some extent for goods, are not aligned with the ground level business realities, one is going to see that yes, even in GST, there are classification disputes. Jokingly, we say that, a situation like a paratha, there have been contradictory advance rulings and there have been distinctions being made between a paratha and a roti or something similar to that. And therefore, these types of classification disputes will continue, and we are seeing them continue even under GST. While we see these disputes continuing under GST, because there are only a few tax slabs, therefore, in many cases, irrespective of the HSN classification, one might end up with the tax rate being similar. And if the tax rates are similar, therefore, many a times HSN classification may become academic. But having said that, I am aware, and many of us are also aware, that there are significant situations where the tax rates do not converge. While we have a general revenue neutral tax rate of 18%, there are special tax rates, 12%, 28%, 5%. And therefore, this classification... May I request participants to please... Aman, is it possible for you to mute all? Yeah, thank you. So therefore, the classification disputes do continue, but the extent of tax implication has to a large extent reduced. On the documentation front, yes, we had a very tricky type of a situation 5 years ago. N number of documents, many of those documents to be obtained from the department. For example, you had a C form, an E1 form, and therefore the obtaining of documentation itself depended on many external agencies. Especially when you have to get a C form, you have to depend on your customer, and that customer again has to depend on a tax officer. And therefore, there was a lot of challenge in getting this documentation, resulting in unexpected tax demands at a later point of time, along with interest and penalties. As compared to that, when we look at GST, I would not say there is no documentation. GST also has an extensive set of documentation, right from the process of how a tax invoice has to be raised, what all should be the fields within the tax invoice, and how you would raise it through a system. When you move goods, what are the types of the documents required? An e-way bill accompanied by a delivery challan or a tax invoice, depending on the scenario. And the law is not forgiving in case of errors. Therefore, I would not say that the documentation has reduced. One would have expected that GST would have reduced documentation, but actually it has not. What has happened as a positive here is that most of this documentation is system dependent. And therefore, if you are following a standard business process, if your systems are geared up to handle the volumes of data for the purposes of documentation, and your systems are aligned with the government systems, typically we find that this documentation is not really big challenge, but it is managed through this alignment of your in-house systems with the government portals. In situations where an organization is not able to align these two systems and is dependent on a lot of external work like a manual intervention or maybe some bridge software, those places we find enterprises struggling. So this is one thing where we are having mixed responses from many clients. Some clients are very comfortable with this, but some clients are finding a lot of effort going in this process. And I think the way forward on this front would be perhaps to look at aligning the systems, the legacy systems, in a way that they would match with the GSTN systems. The next aspect is one area where I'm sure most of us have lots of challenges. And this is one area where the change has not been favorable to the industry and the trade. And perhaps the extent of effort required in this area is so much that it overshadows or clouds all the other benefits which are there within the GST system. And that is relating to the input tax credit. And let's compare how input tax credit worked 5-7 years back and how it works today. 5 years back, when I had to claim input tax credit under the central excise law, central excise and service tax law, I used to claim SEDMET credit as a single number in the returns to be filed. No detailed analysis was required. No matching was to be undertaken. So it was a self-claim based on limited matching. Definitely the department a few years down the line would do an audit, but there would be a limited human effort which a human being can undertake. And therefore, typically the credit claims were much easier in the legacy regime. Under the VAT regime, there was a concept of matching, but there was a limited matching related to a particular state. And that too, in many cases, happened on an aggregate basis rather than an invoice level basis. Now, this is a sea change which is happening in GST. When we come to GST, we see that there is an extensive matching at an invoice level required. Earlier, there were some tolerance limits and there have been lots of disputes in the past. But lately, we are told that unless the credit appears in your document called GSTR 2B, you can't claim the credit. And therefore, there's an extensive invoice level matching which is a prerequisite for claim of input tax credit. This itself keeps all the tax teams and the compliance teams so busy month on month that they really do not have time to think about the other aspects of the tax implementation or even other areas of business or finance. As compared to that, there is also a substantial increase in the powers available to the department officers, to executives, in terms of blocking of credits, disallowances of credits, or issuance of notices. And therefore, this is one area where perhaps there is a lot of activity which is required from the department side in terms of softening the difficulties of GST. Having said so, we are also aware that a small section of the trade, maybe 0.5% or 0.1% of the trade, would be misusing the benefits of input tax credit, and those misuses are reported, and there's a lot of attention on account of those types of misuses. And therefore, the government is not keen on giving a lot of relaxations on this front. In fact, every time we find an amendment, that amendment makes this process even more and more obligatory and more stringent. So perhaps that's again one area where organizations will have to somewhere live with the new normal, as one may say, and one may need to, yes, while this is a little bit painful, a lot more extensive, but this is what appears to be the way forward. And I don't think there's a way we can really look at it in the old regime where one would just claim a consolidated input tax credit in the monthly returns which are being filed. From the legislator's perspective, the past indirect taxes depended highly on notifications and circulars, and that process continues even today. In fact, when we are talking today, there is a press release which we are going to talk about. The 47th GST Council meeting happened in the end of June, and there was a press release wherein various announcements were made. And thereafter, there were notifications and circulars to be issued for them. Quite a few of them have been issued, but some of them have not been issued. And essentially, while many of these things ideally should happen through a legislation like an act or a rules, because any amendment in the act would have to pass through the GST Council and thereafter through the Parliament and 30 odd states. It's not very uncommon that things happen through notifications and circulars. And therefore, this results in a situation of unwieldy management of the information flow. And I think this is something which we would be forced to live with as time progresses. Now, having filed the returns and paid the taxes, a common question which always any tax law would have would be to ensure a proper enforcement of tax, identify evasions of tax or interpretation issues, which we can very loosely put as disputes. And as far as dispute identification process was concerned, the legacy laws, the dispute identification process was fairly non-uniform. Each state law would have its own type of an audit or an assessment or an adjudication mechanism. The center had its own adjudication and audit process, and they also had an intelligence wing. Most of these agencies tried to find or identify disputes through human intellect and through certain market related sources or cross checks. And to a large extent, all of this was localized. And this is one major change which has happened in GST. Because of the extensive uploads and the matching of information, there is a huge database created by the central government at a central repository by the GST. This data lends itself to a lot of intellectual data analytics and artificial intelligence. And through various means, the government is able to find, through a system-assisted mode, pinpointed cases of identified disputes. And therefore, in those cases, there's a much more system-assisted and a pan-India uniform mechanism of identification of disputes. At the same time, there are various different ways in which these disputes comes out. It could be as simplistic as an ASMT 10 notice where a system would just compare a GSTR 1 with a GSTR 3B and say that you have underreported taxes in GSTR 3B. And just some human being somewhere has thought about this logic. He runs this logic through a computer, and if the state has around 20 lakh assessees, a computer generated email goes to all the 20 lakh assessees. And therefore, this is one method wherein the scrutiny of information happens, the cross-check of information happens, and it's assisted by the system, resulting in a uniform application of notices to so many people. And this is a barrage of notices, which I think the industry and trade will now have to live with. Maybe in some cases, the notices may be so insignificant, they may be less than 100 rupees, because a computer would not know a materiality limit, and it would just do an aggregation of data as per a particular field and another field and send a mismatch report to you. So that is how that the process has changed. It has become more uniform because GST law is uniform across the country. Issues also become uniform, and therefore we have so many advanced rulings, and therefore any issue which comes up, it no longer remains under the carpet. And many a times the clients ask us whether they can take some chances on certain things. The answer to that is, in GST is a new way of doing business. You cannot assume that certain aspect of your business or your conduct of business will remain unknown to the tax authorities for a period of 5 years, which is their limitation period. And therefore, again, this is one aspect where one will have to take consolidated and a very clear calculated positions on certain things of interpretation. One cannot just assume that the matter will just stay below the carpet and not come to the attention of any tax officer or any system. So that is where I think dispute identification process from a government side has definitely become much more robust. In a way, it's a positive. I would believe that for honest, organized taxpayers, this results in a much more assurance that if they are doing the right things, they would not be investigated, they would not be harassed. And at the same time, those who are dishonest would be caught. And therefore, there's no premium on dishonesty if disputes are identified in a uniform and a timely manner. The challenge lies in the next aspect, which is the dispute resolution process. Having identified an issue, the legacy laws, because they were through a period of time, through decades they were being there, they were very structured. So there would be an issue of show cause notice, there would be an adjudication, then there would be an appellate forum. And everyone knew their limits. So a show cause notice would be fairly detailed, explaining the allegations and things like that. But in GST, we are finding that because there has been an amalgam of state jurisdiction, center jurisdiction, and everyone is at a different learning curve, we find that this entire dispute resolution process, though the law documents it well in terms of scrutiny notices or ADTs, thereafter the show cause notice, thereafter the first appellate authority and the tribunal authority, The challenge which comes is at times there has been a lack of clarity amongst the implementing authorities, which is the state officers or the center officers, and therefore the process is fairly unstructured. And of course, there are some matters which have gone to courts, and courts have said that in the absence of a show cause notice, recovery cannot happen, and you have to follow the steps, and each of the notices has to be self-explanatory. A personal hearing opportunity has to be given. But despite these types of decisions from the courts, we find that it's not very uncommon for an officer not to grant a personal hearing under a GST law, which wouldn't have been thought about when we looked at service tax law or the VAT regime. So in that sense, it's unstructured. I think as time progresses, it will become more structured when all the learning curves get aligned. This would get reasonably streamlined. The largest challenge which we see is the fact that the GST appellate tribunal is still not set up. There is a constitutional challenge to this aspect. Madras High Court has stayed the constitution of the GST appellate tribunal, but then the government has to find some solution to this and set it up early, because unless a GST appellate tribunal is set up, the first appellate authority is still a revenue authority. The GST appellate tribunal is the first quasi-judicial body where there would be a representation of a judicial member or non-revenue gatherer. And therefore, it's very important. The issues are now, first appellate authorities are adjudicating issues and finalizing appeals. And therefore, there's a lot of bottleneck at that front. I'm aware that a intergovernmental ministerial committee has been set up, and very soon they should take a decision of it on this aspect. But sooner the better is, I think, the aspect which one would look at as far as the dispute resolution process is concerned. So friends, when I'm looking at GST at 5, I would believe that the structural beauty of GST as being a comprehensive tax covering all the taxes is there, and it will always be there. It's the structural benefit of GST. As compared to that, on the implementation front, we find that yes, there are quite a few hits, but there are quite a few misses as well. And therefore, maybe when we look at GST at 10, we should be perhaps much more upbeat and hopeful about the future as compared to what we are today. I think with that little bit of a background on the 5th anniversary of GST, I think we can proceed to discuss the amendments. And over the next few years, till the time the GST remains a work in progress, I'm afraid to say that it still continues to be a work in progress, even after 5 years. At some point of time, I would be very happy to see a simpler and a good and a simple tax, wherein I can say that this is now matured and it's no longer a work in progress. But as of today, yes, the GST continues to be a work in progress. And whenever the GST is a work in progress, or any law is a work in progress, there would be quite a few amendments, and therefore there would be reasons for us to meet and discuss those amendments. The occasion for today's discussion primarily is the 47th GST Council meeting, which happened in the end of June at Chandigarh. They met for a couple of days. The entire GST Council met for a couple of days and made certain far-reaching recommendations. Some of the recommendations are relating to the rate of taxes on goods or services, including the removal of exemptions on certain activities. The objective is necessarily to increase the revenue and also to some extent correct the inverted duty structure or certain aberrations in the existing tax structures. There are various procedural amendments carried out, some of them positive, some of them more onerous, but yes, a lot of procedural amendments have been proposed by the press release, which has been issued subsequent to the 47th GST Council meeting. In continuation of that press release, a series of notifications from notification number 9 to 14 have been issued to implement some of the recommendations made by the GST Council in the 47th meeting. Similarly, a couple of days back, a series of circulars from circular number 170 to 176 have been issued. We are still awaiting the rate notifications, and therefore to that extent, it's still, even the current amendment which we are talking about is still work in progress. Not only talking about the long-term approach of GST, but even the current 47th GST Council meeting discussion is also work in progress to the extent of the rate recommendations. So let's go to the amendments proposed, and this caveat, especially for the first part where we are talking about the change in rates, is going to be important, that with this discussion which we are having in the first few slides is based on the press release. As we all know, a press release is only indicative. It cannot be used for legal interpretations, for which the notifications will have to be relied upon and interpreted. We still await those notifications, but based on our experience, we would discuss some important aspects which are likely to happen based on the press release. As and when the notifications come out, the impacted clients, we would again reach out to you and discuss them in detail, including the issues which specifically emanate out of those notifications. One thing which we are told very clearly is that the amendments are expected with effect from 18th July 2022. I don't know what is the obsession for this odd date, but well, the press release clearly talks about 18th July 2022 as the effective date of the tax rate changes. And therefore, I would believe that the new notifications, the rate notifications, should be out in the next few days so that the industry also would have a few days to read, decipher, and implement those changes. And we are told that the tax rate changes would be effective from that date. One example which I can give you is an example wherein the government is proposing to charge a GST on the hospitals if the room charges are higher than 5,000 rupees per day. Of course, they have clarified that the ICU charges will be excluded, but if the room charges are above 5,000 rupees per day, then they would be liable for GST at the rate of 5% without input tax credit. Now, this amendment, for example, would be effective, we assume, from 18th July 2022. Now, of course, the transitory cases we'll discuss in the next bullet point, but this is what broadly is a scenario. So whenever there's a notification or an amendment in the notification, that amended notification is likely to be effective from a particular cutoff date. Now, when I am talking about this aspect, we also need to bear in mind that the press release also talks about issuing certain circulars to clarify the tax positions. Now, in certain cases, there have been disputes. For example, when an IVF treatment is undertaken, there was a dispute in the past of whether this can be treated as a healthcare service or not, because there's a definition of healthcare service which says that it includes diagnosis, treatment, or care. Now, IVF is something which is sponsored by a parent, an intending parent, and it is not an initial ailment in that in the patient. And therefore, there was a small section of officers who felt that this cannot be exempted as healthcare services. So the government, through a circular, is clarifying, and rightly so, that IVF treatment would also be treated as healthcare services and would be exempted. Now, friends, when we are looking at these types of clarifications through circulars, bear in mind that these clarificatory circulars are not effective from a particular date, but they just clarify the position of the law as has always been existing. And therefore, these types of clarifications would be liable from the first day of the implementation of the law or the relevant aspect. So this difference between a notification and a circular, most of us would be aware of it, but I thought it's important to bring it out because at times the press release tries to intermingle the two things. For example, one more clarification which is sought to be given is that news anchors, if they receive an honorarium for speaking on a television channel, they would be liable for GST, and because that would constitute a consideration for a service and therefore liable for GST. Now, someone would say that now journalists are brought into the GST net. That's not true. Just like this clarification about exemption for IVF treatment would date from day one, the clarification of taxability of honorarium for these types of journalists would also link itself from day one. So that is what I think we need to bear in mind, the distinction between the amendment brought through a notification and a position of law clarified through a circular. Having explained this distinction between a notification and a circular, we also need to understand that in many cases, especially service contracts, there could be a situation of a continuous supply of a service. And in those situations, when there is an intermediary change in rate, how would one look at the situation? And the best example which I can give here is an example of an infrastructure related works contract, like a construction of a road, which as of today is liable for 12% GST. And the press release tries to suggest that from 18th July 2022, this 12% rate will be increased to 18%. Now, in these types of situations, when a contractor is building a road or constructing a road, The construction of a road typically takes a lot of time, and there are stage related billings which are being done. And therefore, the question comes up is, how do I decide whether in a particular transaction or an invoice, should I charge 12% or 18%? This issue has been addressed in the past, right from the service tax regime, wherein we had a point of taxation rules and there was a specific rule dealing with this situation of change in the tax rate. Even under the GST, we have section 14, which deals with the situation of change in the rate of tax. And what does that provide as a guidance? There are various situations, around 6 to 8 situations, which are mentioned in section 14. But the core or the essence of those situations is that typically a taxing point under the GST law, there are 3 taxing points. One is a provision of a service, one is raising of an invoice, and one is receipt of money. And we are told that whenever you have to apply a tax rate, check whether 2 out of these 3 conditions or criteria fit within the old tax rate scenario or the new tax rate scenario. And accordingly, the majority wins. That is the principle which has been brought about in section 14. Let me explain this through an example. Let us say that you are a road contractor. You have done certain work in the month of June. You raise an invoice for the month of June on 20th of July. And you receive money on 25th of July. Now, in this scenario, the 3 touch points, the provision of service is 30th June, old period. The invoice is raised on 20th of July, which is new period. And the receipt of money is 25th July, which also is the new period. So, out of the 3 criteria, 2 criteria are in the new period, 1 criteria is in the old period. And therefore, you will be required to raise an invoice with a tax rate of 18% in this scenario. You cannot then say that because I raised service in June, I rendered the service in June, so I should be eligible for 12%. Now, there's a workaround to this, and all of us are aware of this workaround. My service was in the old period. If I raise the invoice also in the old period, 2 out of the 3 conditions will be in the old period. And therefore, for all the contractors, this week becomes very important. If you are able to raise the invoice for work completed up to June or prior periods, if you have not raised invoice, you have still kept these values in your work in progress, and you would be raising invoice at a future point of time. You can raise the invoices before the new rate becomes implemented. Then 2 out of 3 criteria becomes old period, and the 12% tax rate will apply. I know it's not so easy, and those of my works contractor clients who are on the meeting would know that there is a process of certification, there is a detailed process of raising a statement of invoice. Yes, if you wish to claim the concessional tax rate of 12%, you will have to make sure that you crunch your timelines and somewhere do ensure that the invoice also is raised prior to 18th of July. If you are not able to do that, then you will have to end up paying an 18% because 2 out of the 3 criteria would fall in the new period. An issue which comes up is in case of mobilization advances. I might have received mobilization advance in the month of June. I might provide a service maybe 1 year or 6 months down the line. The question arises is whether I will pay 12 or 18. The fact remains is advances are taxable under the GST law. So you would have anyways paid 12% already. Therefore, would you be required to pay the extra 6% or not is the right question. And the answer to that would depend on whether you are treating a mobilization advance as a milestone and therefore also raising an invoice for the mobilization advance. If you are doing so, then 2 out of 3 conditions is over in the old period. You will have paid 12% on advances. You would have also raised an invoice in the old period, and only service provision happens in the new period. No problems, no additional tax payments. But if you had just raised an advance document in the old period, not raised a tax invoice, and the tax invoice will be raised as and when you are rendering services 6 months down the line. In that case, 2 out of 3 conditions will be in the new period, and you will be required to pay the extra 6%. 12 you have already paid when you received the advance. 6 you will pay when you actually complete the service and raise the invoice. So that is how mobilization advance would get treated, and similar principles would apply in other sectors also where there is a change in the tax rate. As far as debit notes and credit notes or GST credit notes are concerned, this is an important aspect, especially when you're looking at a systems change, because the original transaction was undertaken at a older rate. The debit notes and the credit notes relating to those older transactions would also be at the older rates. Now, many a times when you are working on an SAP or an ERP and you are working on a tax code, this becomes an important distinction, because in future you will have credit notes which are relating to new invoices, which will bear an 18% credit note, whereas in credit notes pertaining to old invoices will bear a 12% tax component. So this is something which one will have to make sure that their systems are reasonably geared up for doing that. Now, this is of course as far as the legal side is concerned. On the practical side, one will also look at invoking the change in law clause and discussing with the clients wherever the contracts are inclusive of taxes, but there is a change in law clause. Then just to ask for a supplementary additional payment, one will invoke the provisions with the respective clients. If there's a reduction in tax rate, a couple of places only, one will have to look at the impact of anti-profiteering and pass on that reduction in the tax rate also back to the client. In many cases, there might be a need for an amendment in a system, especially when you are moving from an exempted supply to a taxable supply. And in this scenario, you also need to note that the exempted supplies, there was no requirement for an IRN to be attached to an exempted supply. But the moment you are transitioning from an exempted to a taxable supply, you will need to generate an IRN. Most of the organizations would anyways be required, will be about 20 crores of turnover and would be governed by the IRN processes. So that is something which one will have to be careful about and also implement those systems changes. This becomes more important in sectors like hospitals and logistics, where there would still continue to be some exemptions and some taxable transactions. And especially if in the same transaction, some part is exempted and some is taxable. Like when you look at a hospital, it's only the room charges which are taxable. Everything else is exempted. The question which arises is, can I make a single invoice which includes both the taxable component as well as the exempted component? The general answer is no. For a B2B transaction, you are required to raise a tax invoice for the taxable component and a bill of supply for the exempted component. For a B2C transaction, there's a special concession which has been given, where we are told that if the customer is a B2C customer and he is okay with a combined document, you can raise a single document which is known as a tax invoice, bill of supply. And there you can have a column which talks about taxable component and the GST thereon and the exempted component separately. So accordingly, the systems will have to be geared up to classify B2B versus B2C. For B2B, incorporate the IRN QR code and also make sure that there's a distinction between a tax invoice and a bill of supply. And as far as the B2C is concerned, you can have a combined document called a tax invoice or a bill of supply, and that would definitely not include an IRN QR code. So these are some changes which would be generally applicable based on how the tax rate impact gets impacted. Having talked about the general discussion, we now go to the specific tax rate changes, and here we've tried to be selective and cover only the prominent ones. Again, what we've tried to do is we've tried to cover them in terms of classification vis-a-vis certain sectors as we understand, sectors or industries as we understand, rather than just give a sort of a alphabetical listing of all the proposed tax changes. And for as far as this tax rate changes is concerned, our advisory is also classified sector wise and is very, very comprehensive. I'm sure all of you have received it and gone through it. If you have not gone through it, please go through it. You will get a much more detailed verbiage on each of these aspects, which we are going to discuss over the next 2 or 3 slides. The first sector where the impact one could see is what we have already discussed, which is relating to the healthcare services, the hospitals. A major change proposed is about the room charges becoming taxable at 5% without ITC if they exceed rupees 5,000 per day. Now, this of course has opened up a Pandora's box. Hospitals are not geared up to implement this, much more pay the tax. Definitely healthcare would become a little bit costlier. But more importantly, I also see that there will be a lot of dispute, especially at the time of insurance claim settlement, because most of the hospitalization today is governed by medical insurance. And the medical insurance, the caps are based on the room charges. Now, it will all depend, and the insurance companies will have to clarify this aspect. that when they say that 1% of your sum assured is eligible as room charges and all your claims will be accordingly proportionately allowed, are we going to talk about a scenario of a gross room charge or the basic value of room charge excluding GST? Now, this is something which the insurance companies will have to clarify, and it will have ramifications on your insurance claim settlements, especially in case of indoor hospitalization and situations like that. Be as it may, we'll wait for more guidelines and the conduct of various parties like the hospitals and the insurance companies before we really can comment with assertion on this aspect. Few more situations: cord blood banks are made taxable. Similarly, biomedical waste treatment facilities are made taxable. We already talked about the IVF treatment clarified to be exempted. For orthopedic appliances, the tax rate is being reduced from 12 to 5%. Again, a specified list of orthopedic and ostomy appliances, the rate has been reduced, not all of them. So one will have to go into that notification and the classifications and then take a call of whether the product which you are dealing in has the benefit of this reduction of tax rate. That takes me to the next sector, which is transportation and logistics. And this is one sector which always has a number of amendments. Especially the goods transport agency initially had a reverse charge mechanism wherein the company used to pay the GST at the rate of 5%. This resulted in denial of input tax credit for the GTA. So in the interim, the government brought in a situation wherein a transport agency can choose either a reverse charge mechanism with 5% and therefore no input tax credit to the transporter, or a 12% where they would charge under forward charge. They would collect as a transporter, the transporter would collect from the company 12%, and it would be eligible for input tax credit of, let's say, the GST charged on the vehicles and the various expenses. These two options were available, and we were told that the agency will choose one of these two options and uniformly apply that option across. Now, in this press release, we are told that a third option, which is 5% forward charge mechanism, will be given to the GTA. It flows without, it goes without saying that this 5% would be without ITC. It's a presumption, but we will have to wait for the notification. Most likely, it would be without ITC. Now, therefore, there's a choice of either the transporter paying tax under reverse charge or the customer paying tax under forward charge. And this is where there will be a lot of commercial dynamics which will flow in. Most of the times, the company paying the freight would want to play safe and they would want a reverse charge so that they have a challan. Whenever their audit or assessment happens, they just show a challan and claim the credit, and that makes life a bit simpler. As compared to them, that if the transporter is charging 5%, they are dependent on the transporter uploading the tax in the GSTR to be matching the credit and claiming the credit based on the payment of tax by the transporter. Therefore, definitely from a company's perspective, they would choose or prefer a 5% RCM over a 5% FCM. As compared to that, a transport agency would say a 5% FCM means I am getting the money, maybe I'm using the float for a few days or a month, and I'm paying the tax, so I don't have to run after the companies and obtain a certificate from them that they have discharged the tax under RCM. So this is going to be a sort of type of a commercial dispute which we are entering into by giving so many options. I would believe that life would have been simpler if everything would have been kept under one, but well, there are sectors who get impacted because of it, and therefore they make representations, and based on those representations, the government wants to give options. So there are options, and once there are options, implementation of those options becomes much more difficult. So when we'll have to live with this aspect, again, look at how the notification is worded, and maybe companies will also have to amend their systems, because many a times company, they would have just one ledger where all the freight would go and they would end of the month total that up and pay RCM. Now, if that has 2 or 3 components like 5% RCM, some transporters doing a 5% FCM and some doing a 12% FCM, naturally the company will have to have 3 freight expense ledgers in their books so that they can correctly discharge their RCM taxes as applicable. At the same time, from a transporter's perspective, certain exemptions for transport or storage of specific products like agriculture, some of the agricultural products is sought to be withdrawn. Their detailed list is given in our newsletter. I will not spend time on that. The third change is that the rate for renting of goods carriage is reduced from 18 to 12%. So now hiring of a goods carriage like a tanker or a truck is sort of at par with 12% full RCA, full forward charge mechanism with ITC. So, and of course, even renting is eligible for ITC. So somewhere that classification issue between whether the transaction is a renting of a goods carriage or whether it is a transportation of goods by road, that dispute becomes academic to some extent. As far as infrastructure is concerned, we talked about it, that there was a concessional rate of tax rate of 12% for various works contracts which were in the nature of infrastructure works contract. Now, some of those concessions have been withdrawn. The press release suggests that definitely there are concessional tax rate for roads, bridges, railways, metro, effluent treatment plant, crematorium, and also for government contracts for historical monuments, canals, dams, pipelines, educational institutions, hospitals, etc., is sought to be withdrawn. The question remains is there something which remains in 12%? I think we'll have to see. Most likely there would be hardly a few items which will continue to get this concessional tax rate of 12%, but we'll have to wait for the notification and then only take a call. Corresponding to the removal of the concessional rate for the main contractor, even the subcontractors would move from 12 to 18%. Now, government works contracts which involved only earthworks and less than 25% of material attracted a concessional tax rate of 5%. The concession continues, but the rate is now not 5, it will be a concessional tax rate of 12%. So the rate is increased from 5% to 12% in case of such earthworks related contracts. Now, coming to hospitality, there was an exemption for hotel accommodation below 1,000 rupees per day. Now we are told even those cases there will be a GST applicable at the rate of 12%. Now, while this might impact only the hotel sector, one would believe, but there have been various situations where there has been this 1,000 rupees per day exemption has been used to an advantage in situations which are not pure play hotels. For example, a dharamshala or a temple which has certain rooms where a pilgrim can stay. In all those cases, or even many a times senior citizen homes, where senior citizens is given a stay for some fixed amount per day. And most of those cases, the amounts per day charged were less than 1,000 rupees. And one used to take a position that, look, because there's an exemption, a basic threshold of 1,000 per day, so many different types of sectors were getting out from the purview of GST. Now, with this hotel accommodation entry attracting a GST at 12%, and that exemption going away, each of these situations, which traditionally may not be categorized as a hotel, would also have to relook at the positions which they have already taken. In the hospitality sector, an ice cream parlor is one subsector which has always seen a lot of difficulty. In October 20, and the difficulty was whether these ice cream parlors are treated as restaurants or as shops, because restaurants are liable for 5% without ITC, whereas shops are liable for 18% with an input tax credit. In October 21, based on various conflicting advance rulings, the council clarified that ice cream parlors are more like shops rather than restaurants, and therefore they will charge 18% and they will be eligible for input tax credit. But prior to that, there were advance rulings which were against, and many organizations or many ice cream parlors took a position of paying 5%, treating themselves as restaurants because they would have a seating arrangement, and to a large extent they appear like a restaurant to an external person. So they were doing a 5% without ITC, and they were therefore worried because of this circular. And therefore the GST Council says that, okay, if there have been ice cream parlors who have charged 5% without ITC up to 5th October 2021, we will regularize it. We will not issue show cause notices, and we will not expect them to pay the tax for the past period. Please make no mistake, moving forward, the circular of October 21 will apply, and ice cream parlors are treated as shops. They would be liable for 18% with input tax credit, and they are not treated as restaurants. This is only a timed concession given for certain actions which the ice cream parlors already took based on confusion prevalent in the industry. E-commerce operator again is a sector which is a growing sector, and a couple of restrictions under the law, whereby we were told that an underlying supplier was not eligible for a threshold or a composition, resulted in a lot of such small players not approaching a e-commerce operator, and therefore their businesses were restricted. So this GST Council, we've taken a decision that the underlying suppliers would be eligible for the basic threshold and the composition options, and therefore they did not worry. They did not just sell products in a normal brick and mortar model. They can get themselves listed with e-commerce operator without worrying too much about the GST consequences of this type of a listing on an e-commerce portal. On the real estate, there were conflicting advance rulings on the sale of plotted land after development. Luckily, the better sense prevailed, and we are told that the land continues to remain a land even if there's some development done of that land and there's a plotting done. So long as there's no habitable structure on it, it continues to remain a land, and therefore it is outside the purview of GST and not taxable. Some other specific changes which I thought might be generally relevant would be the fact that the rate for e-waste, the tax rate for e-waste has been increased from 5% to 18%. Many of the organizations today have a policy of disposal of e-waste, and whenever they get some scrap value for this e-waste, they would be required to pay 18% GST. The second one is also important. Many organizations have guest houses which are in the nature of residential premises, and they have taken it on a rent from some third party where their directors and all might stay. Now we are told that if there is a renting of a residential premises, even if it is used as a residence, it will be taxable if the tenant or the person giving the rent is a business entity. Again, I talked about this. There's a clarification that an honorarium paid to a guest anchor would be liable as for GST because it would be a consideration against the services rendered by. A favorable clarification again is that a perquisite given to an employee under an employment contract is not liable for GST. Of course, there was a similar clarification in the past as well, but there have been quite a few advanced rulings which are against, again, favorable as well as against on this point. Finally, services rendered by the Department of Post, though it is a government, we are told is no longer be liable for RCM, and the Post Department would collect the GST, and therefore the corporates are relieved from the obligation of RCM in case of services rendered by the Department of Post. So friends, that summarizes the amendments which have been proposed in terms of the tax rates and exemption changes. Just for a moment, I would like to highlight that these are all tentative. Of course, they would come in a particular fashion, and one will have to read the fine print of the notifications as and when they come. As far as the second part of the GST Council meeting agenda was about the procedural amendments, quite a few procedural amendments have been carried out, and luckily on this front, a lot of them have already been out in the public domain, either by way of an amendment in the rules or by way of notifications or circulars, the numbers which we talked about in one of the earlier slides. So we will go one by one on each of these aspects and try to understand what are the key changes as far as these procedural amendments are concerned. Friends, on the front of registration, the law provides for an automatic suspension of registration if a taxpayer does not file returns for a particular number of months. Now, once suspended, the person has to file the returns and then go to the officer and apply for a revocation of that suspension. Now, what we are told is to ease the business processes and also reduce the paperwork, we are told that if your registration is suspended on account of non-filing of returns, and before cancellation of the registration, because suspension is an intermediary process, before it gets cancelled, after suspension, it might get cancelled after some time. If before cancellation, if the person files all the pending returns, there will be an automatic revocation of the suspended registration on the portal. So this is a welcome change. It reduces the hassles and the paperwork as far as the such types of taxpayers is concerned. But more importantly, I think it's important to bear in mind that we don't even go into the zone of suspension. We are regular in filing the returns because there are various other aspects along with suspension. And definitely today in an interrelated ecosystem, if your registration gets suspended, your vendors would know that your number has got suspended, and even your customers would know. And none of them would be happy with the fact that your number has got suspended. And it really puts a sort of a dark cloud on the overall business integrity and the process. And therefore, it's important that the dates 11th and the 20th, the dates of filing the GSTR 1s and the 3Bs are strictly complied with by most of the taxpayers. And our experience is that yes, 90% or 95% of the taxpayers do respect that type of a timelines. As far as filing of returns is concerned, the current process, I think, is more or less stabilized over a period of time. It has got stabilized. Every time you raise an invoice, you generate an IRN. The auto population of that IRN comes into your GSTR1, and therefore the B2B part of your GSTR1 is to a large extent auto populated, subject to errors and omissions. The B2C component has to be filled up in the GSTR1, which has to be filed by the 11th. Your GSTR1, the B2B component gets auto populated in the customer's GSTR2B, and at the end, around 13th or 14th, once the GSTR2B comes into place, the GSTR3B is auto drafted based on the output tax as reflected in GSTR1 and the input tax credit proposed by GSTR2B. You are allowed to edit the GSTR3B, make the payment of taxes by the 20th of the next month, and this cycle continues month on month. At the end of the year, the GSTR3B auto populates itself into a financial year total into GSTR9, and in GSTR9C you reconcile the figures of GSTR9 with the financials and file that. So that process of IRN going into GSTR1, into GSTR2B, into 3B, and thereafter into 9C on an annual basis is going to be a sort of a midterm or a long-term process, which is clearly an indication coming from the government. In between, we did talk about various other mechanisms, but all of them have been found to be unworkable. And this process, I think the government is very clear that this is going to be a stable midterm or a long-term process. Within this process, as far as IRN is concerned, the Revenue Secretary has been on record to say that the current 20 crore threshold limit for IRN will be progressively reduced, because they are seeing that the data capture at the government level is happening at source if they are insisting on an IRN from a government portal. Now, as we are also aware that a few more invoice registrars have been appointed with the private sector also have been appointed, and in essence, the IRN process has been reasonably streamlined and smooth. And therefore, it's important that one, if he has not really integrated or aligned the IRN processes, he does that. Of course, we are aware that certain sectors like banking sector, airline sector, etc. are exempted even if their turnover is about 20 crores from the IRN process. Now, Rule 48 has been amended recently to say that these types of entities whose turnover is admittedly about 20 crores, but because of Rule 54, specific exemption has been given from issuance of IRN, they will have to incorporate a declaration in their invoice stating that they are exempted from issuance of an IRN. So this is one important aspect which those types of organizations who are in the banking sector or in the airline industry or the transport industry will have to be careful about and incorporate this standard declaration on each of the invoices which they are going to issue. The next change is in a series of changes rather in GSTR3B. Now these changes are very important. I request participants to keep themselves on mute. These changes in 3B are very important, and they are substantial changes on a long-term basis. Of course, the basis or as stated for these changes is that whatever taxes are being paid have to get divided between the center and around 30-31 states. And today, the taxes paid through 3B, when they have to get divided between the states, government is finding some challenge in the information which is available to the government to allocate the taxes to the center and the states. And therefore, certain changes are clarified to be made in the processes through the circular. Now, what we are told is, firstly, of course, is a simplistic thing. Section 9(5) says that in certain cases, the e-commerce operator will pay the full tax. For example, in case of restaurant activities, the Swiggies and the Zomatos will be required to pay the tax. Now, the separate table is incorporated in 3B to disclose the turnover related to such e-commerce transactions. So that was anyways long overdue and it has come. Nothing great about to discuss about that aspect. But the second one is important, and that is relating to the B2C transactions. We are told that whenever there is a B2C transaction, we are all aware that because of a B2C nature of the transaction, nobody else claims the credit, and therefore this is the real tax which the governments get. and they have to divide this tax between half of the tax going to the central government and half of that going to the consuming state. Now, how does one know the consuming state? For that, the place of supply is important. Now, we've seen situations where, because the supplier does not put the correct place of supply, the B2C tax, rather than going into the actual consuming state, sticks back to the origin state rather than the destination state. And therefore, there's a detailed guideline given whereby we are told that organizations should capture the place of supply clearly in case of B2C transactions in their system. And after capturing this place of supply clearly, it should be classified correctly in the GSTR 3B, so that the state governments, the correct state governments, get the correct taxes. So far, again, this is, as far as this point is concerned, it's important from a government settlement perspective, but it results in a lot of systems changes at an organizational level, especially in cases where the customer is not under any specific obligation to mention his address, because place of supply in most of the cases is the recipient's address. And especially today, when we are looking at e-commerce and internet-enabled businesses, digital economy, there are many situations where somebody sitting somewhere, he might just procure a goods or service online and he may not mention where he is. So in those situations, it's going to be important that proper systems are set up to track and identify the consumer and the location of the consumer, so that the tax can go, the state component of the tax rather, can go to the correct state. On the input tax credit, again, major changes are being proposed. As of today, what happens is that whenever somebody uploads a tax as a B2B tax, it stays in a temporary basket, because the basic thought process is that a B2B tax is available as a credit, and therefore the allocation between the center and the state does not happen. Now, some part of the B2B tax may be ineligible as credit or may need to be reversed. Now, in many organizations, the blocked credits are not identified separately, and therefore they do not go in the 3B separately. So my B2B might show, my GSTR 2B might show a B2B procurement of 10 crores, but my input tax register will show 9 crores because it does not include the block credit. And I would match the 9 crores, ignore that block credit, because anyways I have expensed it off in my books of accounts, and I would claim 9 crores. I would not struggle to find out what is the amount of block credit. Now, what happens from a government side is that 1 crore, which you have not claimed as credit, and which is right, you have not done any wrong thing up to here by not claiming that 1 credit, you are not eligible, you are not claiming. But the government still has a suspense of 1 crore. It is lying in B2B, but it is not going into the electronic credit ledger. So they are not able to divide these taxes internally. So therefore, the 3B is being amended to say that all such types of B2B transactions, wherever there is a reversal of a tax, maybe because of a block credit scenario, or maybe a Rule 42-43 reversal not being for the business, etc. Or even it could be temporary reversal. An example like a vendor has uploaded the credit into your account, but you have not booked the invoice in your system, or you have not paid the vendor within the 180-day period. So these are temporary reversals. So what we are told is all these B2B transactions incorporate the reversals, and therefore the GSTR 3B is sought to be amended to bring in 2 rows, one dealing with temporary reversals, one dealing with permanent reversals. Just to reiterate, permanent reversals will be situations like section 17.5, which is a block credit. It would include situations of Rule 42-43, where you are not eligible for credit on a proportionate basis. And therefore, once reversed, you are not going to take it back. As compared to that, a temporary reversal will be something where you are reversing it today because, let's say, 180 days have expired and you have not made the payment to the vendor. But in future, when you make the payment to the vendor, you will reclaim the credit. So therefore, it is known as a temporary reversal. Similarly, you might have a scenario that the vendor has uploaded the tax in your account, but you have not claimed, you have not booked it in your books, or you want to claim the credit a bit later. In these types of situations, they would be known as temporary reversals. And therefore, the GSTR 3B, we have to show all these reversals separately, temporary as well as permanent reversals. And if there are temporary reversals which you are subsequently reclaiming, in that case, that reclaim of temporary reversals also has to be disclosed separately. Now, when I'm talking about all of these, friends, I'm aware that it looks very simple in a bullet point. When it comes to a practical scenario, things can become very messy. It will require substantial changes in your systems and approaches. And our teams will touch base with you individually to make sure that how we can make sure that we implement these changes in a manner in which we are able to comply with the spirit of the circular and the clarifications, and at the same time reduce the type of the efforts required, as well as ensure that the return is error free on an overall basis and prone less for errors. But this is one important change which, and a detailed circular has been issued, which I would request all of you to just go through it and then reach out to your teams, relationship managers in our team, so that we can, on an individual basis, align the approaches to handle this change in the process in disclosure as far as GSTR 3B is concerned. As far as GSTR 9 is concerned, the exemption for turnover below 2 crores continues, and therefore they are not required to file GSTR 9. Between 2 to 5 crores, naturally there is only 9, and above 5 crores, you will end up filing both 9 and 9C. All of that continues exactly the way it was for the earlier. Now, having filed the return, the question comes about payment. And payment, as we all know, typically happens through the electronic cash ledger. We have been used to the normal modes of payments like online banking or a check being issued or a debit card or a credit card. We are now told that you can make payments through UPI or an IMPS mode also. Not just a few more modes of payment being introduced, more the merrier, no issues on that. We are aware that the TDS, TCS credits, you have to file a return and these get credited into your electronic cash ledger. An amendment which is now implemented is the facility to transfer the balance in an electronic cash ledger from one branch to another branch of the same PAN. So if you have multiple registrations in different states and you have a cash balance in the state of Maharashtra, but you do not have cash balance in the state of Orissa, you can file a document called PMT9 and transfer the cash balance from Maharashtra to Orissa. Please bear in mind that they should be of the same legal entity having the same PAN. Within the same group, if there are two different companies, you cannot transfer it in that fashion. Of course, at any point of time, if you feel that there's a huge cash ledger balance lying idle in your account, you can always file a refund claim at any point of time. There are no restrictions of filing refund claim as far as the electronic cash ledger balance is concerned. An important aspect, therefore, which comes out from this discussion is that the balance in electronic cash ledger is really like your cash, like your normal bank account. And it is not in the nature of a tax. In fact, it is to be treated as a tax paid only when a subsequent offset is made from an electronic cash ledger. And this is one aspect which many a times industry or organizations miss out. They might make a payment of 50 lakhs into the electronic cash ledger, and according to them, they have paid the tax. But there is one more step thereafter, which is an offset from electronic cash ledger by using either the GSTR 3B route or the DRC route. Until you do that, your tax is still unpaid. And we've seen a couple of situations where this has resulted in an unprecedented situation. One example which happened was an organization paid certain import of services RCM through a cash ledger, and the amount was kept in the cash ledger. They assumed that I have paid this RCM, so the matter is over. And the matter continued in the cash ledger. And after 3 years, when the department did the audit, they said that, look, according to me, this is the RCM payable. And in your return, I am not able to see this RCM. So the person said that, look, I have paid the cash. He says, no, but you have paid the cash, but it is not offset either through GSTR 3B or DRC 3. So he says, okay, I'll offset it today. But when you offset it today, the question comes is 3 years interest. And a show cause notice was issued for demanding an interest for 3 years. And basically the challenge then would be that SSE says, or the taxpayer says, I have already given the money to the government. Why should I pay interest? This aspect of offset was missed out. And therefore, this becomes very important. Of course, you will argue on the grounds of effects, out of pocket theory. But preferably one should be careful that if there is a huge cash balance lying in your electronic cash ledger, one should keep on reconciling that balance to make sure that such simple steps like offset not being done are not missed out from the overall process. That takes me to the electronic credit ledger balance, and there is a circular issued on this front, and an important circular because there have been lots of confusion on this front. The law says that balance in an electronic credit ledger can be used for any payment of output tax. And when they said payment of output tax, there was a Orissa High Court decision in the context of pre-deposit, which interpreted output tax very narrowly. And therefore, this circular now says that no, this is not how we want to look at it. It says it can be used for any payment towards output tax. It qualifies it by saying whether self-assessed in the return or payable as a consequence of any proceeding instituted under the provisions of the GST law. So it's not only the GSTR 3B where you can use the electronic credit ledger, but you can also use it in the DRC 3 through which, for example, if there's an assessment and based on the assessment there is some tax payable, you can pay that, assuming it's an output tax, you can pay that using the electronic credit ledger. That is what this circular clarifies. It also clarifies where you cannot use the electronic credit ledger. And it says very logically that it cannot be used for paying tax on reverse charge mechanism. It cannot be used for paying interest, penalties, and amounts other than output tax. It further says that if you have received an erroneous refund, which you got because of your accumulated input tax credit, you got it in cash. Now, if this erroneous refund has to be re-refunded back to the government, you cannot pay it from your credit ledger because that would mean an undue benefit for you. Up to your fine. I believe it's a fairly balanced circular. Only thing is there's no explicit mention about a couple of situations which have been litigated. One of the situations which is litigated is relating to pre-deposit under GST. And the Orissa High Court decision, which I was just referring to, Jyoti Constructions, deals with a situation where an assessee wanted to pay a pre-deposit from an accumulated balance in electronic credit ledger. And the Orissa High Court says that no, it cannot be so paid. I would believe that this circular is beneficial. The second bullet point, as you can see, it says any payment towards output tax payable as a consequence of any proceedings instituted under the provisions of the GST law. So if there is an order in original which demands 100 rupees of output tax, clearly that 100 rupees can be paid from electronic credit ledger. So if I can pay, if I want to settle the matter and pay 100 rupees, I can pay from electronic credit ledger. Now, I am disputing that amount and I want to file an appeal and I have to pay a 10% pre-deposit. It would be unjust to say that I could pay 100% from electronic credit ledger, but I cannot pay 10% from electronic credit ledger. So I would believe that this circular can be, to some extent, though it falls short of explicitly mentioning the situation of pre-deposit under the GST law, I would believe it can be used, and definitely it, there would be a situation of paying the pre-deposit under GST from the electronic credit ledger. Of course, the demand has to be towards output tax. It couldn't be towards a reverse charge mechanism. Otherwise, there could be a challenge. There's also no explicit mention of pre-deposit under earlier laws like service tax or VAT being made from the ledgers under the GST law. In this context, there is a section under the GST law which talks about recovery of arrears as GST dues. And there have been a couple of decisions which have permitted pre-deposit of earlier laws from the GST law. But at the same time, at a ground level, we are finding lots of challenges if a pre-deposit of a service tax or a VAT is made from a GST law. So as far as possible, it is an avoidable situation. As it is, you have to pay the taxes. So it may be better to pay the taxes under the legacy laws, under the assist, login, rather than going through the GST mechanism. That takes us through into the aspect of interest, and again, a welcome change which has been talked about since quite a few years, initially through a GST Council meeting, thereafter finding its way in the law, and at least 2-3 years we have been talking about it, and ultimately that amendment sees the light of the day, luckily from 1st of July 2017. And the situation, as we are aware, is the situation which arose from the Telangana High Court decision in the case of mega engineering. wherein the person had to pay, it was a case of a contractor who had to pay an output tax of, and these are the numbers, actual numbers, 1,000 crores. He had a back-to-back subcontract, so there was an input tax credit of 980 crores, resulting in a net tax payable of 20 crores. But he did not have that money with him, and GSTR 3B could not be filed without the discharge of full tax payment, and therefore his GSTR 3B got delayed. And whenever he could get that 20 crores, he filed the GSTR 3B and paid the interest on that 20 crores. The Telangana High Court said that, look, because the offset of both the cash as well as the credit ledger happens on the day of filing the GSTR 3B, therefore interest is payable not on only the 20 crores of cash payment, net cash payment, but on the entire 1,000 crores, including the credit component. And this was, of course, fairly unjust and matter where, was being discussed through the policy corridors. And as I told you, 3 years we have been talking about it. Ultimately, Section 50 amendment has seen a notification, and now we are told that if you are paying any output tax through a delayed GSTR 3B, again there's a caveat, for the same month. So we are actually covering only the Telangana High Court type of a situation where, let us say for the month of July, you have declared certain invoices in GSTR 1. The output tax goes in GSTR 3B of July. You have to file and pay the taxes on 20th of August, but instead of that, you file it on 31st of August. And the tax is paid, let us say 80% through credit and 20% in cash. Now, in this scenario, we are told interest is payable only on payment from electronic cash ledger and not on payment from electronic credit ledger. A welcome change, but a very specific change only for a specific type of a scenario. Make no mistake, in all other cases, the law would say that the interest is payable on the entire amount from the day it was due till the date of the offset, presumably irrespective of the source of utilization. Of course, one can argue in those cases that if the utilization is from a credit ledger or a cash ledger where the amount was already deposited in the cash ledger since long, one can argue on first principles to say that the taxpayer is not out of pocket, and we have this Karnataka High Court decision in Reflex Industries which can come to your rescue, but it's going to be a long haul. And the way the law is drafted, the law would very simply say that except in case of delayed 3B, in all other cases, interest is payable from the due date till the date of offset. So that is an important aspect which we need to bear in mind. As far as RCM tax is concerned, clearly this has to be paid in cash, therefore interest is payable. As far as ITC reversals are concerned, they get classified into two baskets. One is a situation where the legislation itself talks about specific ITC reversals and deems this as output tax alone, talks about interest payable on that under Section 50, subsection 1. Two specific scenarios: a scenario where you have not paid the amounts to the vendor within 180 days. The Section 16(4) read with Rule 37 itself clearly says that you will reverse the tax along with interest. And this interest also has been mentioned from the date of the invoice till the date of the reversal. Now, in these types of situations, I think we will have to respect the law the way it has been mentioned. Same way, whenever after doing a provisional reversal, if at the end of the year you are doing a final reversal, you are told that that final reversal will be along with interest from the first day of the financial year till the date of actual reversal. So in those two cases, I think because of the specific provisions, we will have to respect those provisions unless one wants to go back to the intent of the law and the effects. But as far as other situations are concerned, where perhaps the transaction could have been block credit, but you took it, and later on you realize that you have wrongly taken it, and therefore you are reversing it. So these types of general ITC reversals for wrong availment, and again there has been a favorable amendment in the law which has got notified. This gets classified into two baskets: credit which has been availed but not utilized. You always have a electronic credit ledger balance lying, so you have not made any benefit out of it. We are told that in these situations, no interest is payable. The interest is payable under 50 subsection 3 only if ITC has been availed and utilized. Now, we have a rule which explains how do you understand this utilization. What is meant by utilization? They say that you take the electronic credit ledger balance right from the date of availment till the date of reversal. Find out the electronic credit ledger balance, find the minimum balance. If that minimum balance is less than the ITC availment, then there is a utilization. If consistently your electronic credit balance is higher than the ITC or wrong ITC availment, clearly you have not utilized it. So to the extent of, to give an example, if I avail the credit of 1 lakh in July 2017, and I realize today that it is wrongly availed and I want to reverse this 1 lakh. But from July 17 till date, always my ECR balance is above 1 lakh. Then there is no utilization. I don't need to pay any interest. I can just reverse the 1 lakh of input tax credit. But assume that during this entire period, sometime in October 2020, my electronic credit ledger balance has fallen to 10,000. In that case, it means that out of 1 lakh, 90,000 has been utilized in October 2020. And then interest meter triggers. Then I have to pay interest. This interest I have to pay from the date of utilization, which is October 2020 in my example. And the actual date will be the date of furnishing the return or the due date of furnishing the return, which will be 20th of November. From that date till the date of reversal. This is the period for which I will pay interest. Again, there was earlier a debate of 24 versus 18. We are now uniformly told all these cases, the interest rate will be 18%. So this is how it will be calculated. Now, a couple of things which come to mind. How do I calculate my ECR balance? Will I take the aggregate or will I compare the specific heads of availment like CGST, SGST, IGST? I would believe you will take it in aggregate. You will take the aggregate ECR balance. You will take the aggregate wrong ITC availment and compare it for this decision making. If we don't do it that way, we need to bear in mind that IGST is forcefully utilized. And therefore, effectively, this entire concession may become a non-starter for wrong availment of IGST credit. And that is not the intention. Even when we go to the definition of input tax credit, it is a single basket of credit with sub baskets within it. And therefore, I would believe that you would always compare the aggregates rather than looking at CGST versus CGST availment, SGST balance versus SGST availment. Of all the heads and then compare and then decide the applicability of utilization and the interest there. That takes me to the next sector of discussion, which is relating to exporters and refunds relating to exporters. And as far as exporters are concerned, the hanging sword on them about eligibility for exemption or on import under the foreign trade policy schemes, that exemption is being continued. So if you are importing under advance authorization or an EPCG or an EOU scheme, the exemption of IGST will continue to be available to you. Of course, it is subject to the fact that you will not claim rebate on the exports thereafter. And we have that rule 9610, which has been a controversial rule and a lot of amendments which happened. But subject to that, your import continues to remain exempted and that exemption is being continued. On export, many exporters receive duty credit scripts earlier known as MEIS or ACIS, SFIS, etc. And we are aware that these are considered, these are given exemption or zero rating, nil rating. And because they were not liable for tax, many situations, manufacturers and service providers have faced action from the department saying that because this is exempted supply, Rule 42 triggers and you are required to reverse proportionate input tax credit on the entire input tax credit claimed by you. Now, there is an explanation inserted to Rule 43, which says that the value of duty credit scripts will not be considered as exempted supplies, and therefore this will not trigger the requirement of reversal of input tax credit. A common question which comes up is, what is the effective date of this amendment? Because it's an amendment to an explanation to a rule, there is a good case to argue that this is rectifying a defect which was existing, and therefore it is clarificatory in nature, and therefore it should be given a retroactive effect from the 1st of July 2017. Of course, this will be litigative, but there is a good scope to argue in that manner. Another situation which happened and which was very commonly happening was that if there is an erroneous refund which has to be paid back, naturally that payback has to happen through the cash ledger along with interest and penalties. There was no mechanism for this refund to get recredited into my electronic credit ledger. Remember, originally I claimed a refund by debiting my credit ledger. The government did not object to my credit, but it only objected to my claim of refund. So I had to pay back that refund, which I paid through the cash ledger. So therefore, to make good my original step, my credit ledger has to be reinstated. And there was no mechanism to do that. So the government has now provided for a mechanism wherein they have said that the officer will pass an order in PMT 3A based on which the amounts will get recredited into my credit ledger. The next again is a step wherein we are told that if you are exporting electricity or if you are a duty-free shop selling goods to international tourists, these transactions would be treated as exports and would be eligible for refund of accumulated ITC in a fashion like what a normal exporter gets. A small technical amendment for exporters filing refund claims under Rule 89, wherein you are filing a refund for accumulated ITC based on the value of exports. Here you are told that the value of exports will be the lower of the FOB value in the shipping bill or the invoice value which you are raising to the foreign customer. Many times because of exchange fluctuations or because of contractual terms being CIF or some other terms, there might be a difference between these two values. If there's a difference, we are told that the lower of these two values will be taken as the base for calculation of the export refunds in your formula. As far as rebate application is concerned, when you are exporting goods on payment of tax, the rebate is processed by the customs authorities. Now, in that case, a couple of situations which were happening, that there was an automatic matching of the shipping bill filed with the customs authorities with the GSTR1 data filed by the taxpayer. And when the GSTR1 is filed, the rebate application was deemed to have been filed and the rebate was coming through the customs route. Now, if there's a mismatch between the shipping bill data and the GSTR1 data, the matter was getting stuck. And here we are told that you can amend the GSTR1 data, and the moment the GSTR1 data is rectified, the rebate application will be deemed to have been filed when that mismatch is rectified. Further, if that rebate application is blocked due to some risky tagging, because the GST authorities have a power to tag a particular exporter as risky, as being either a fraudulent exporter or purchasing against some fake invoices, etc. In that case, as of today, the customs authority were unable to take this process further. And now we are told that the application will be sent to the GST department. So you will follow up with the GST department and explain your case. Maybe it was an erroneous risky tagging. And based on that, the GST commissioner or the authorities there would further process the rebate application as if it's a refund application under Rule 89. Again, there's a simplification of refund process for recipients of deemed exports supplies. I'll not go into that into too much detail. One change, a major change respecting a Supreme Court decision in VKC Footsteps case is relating to the calculation for refunds for inverted duty structure. As we are aware, in inverted duty structure, a proportionate refund is available only to the extent of accumulation of ITC on account of inputs. Now, while theoretically this looked very nice, the formula which was presented in Rule 89.5 required a reduction of output tax in totality from the input tax which was attributable only to inputs. This resulted in many cases, this eligible refund coming to a negative or a zero figure. And this was the formula which was even pointed by the councils in the Supreme Court to the Supreme Court. Supreme Court sympathized with that issue, but they just instructed the government that you may look into it and make a suitable policy change. And therefore, this policy change is happening, wherein we are told that while I am treating the net ITC to be only inputs, when I am reducing the proportionate output tax, I will reduce the output tax also only proportionate to the inputs. And for that, a formula has been given to calculate the proportionate output tax multiplied by inputs divided by inputs and input services. And therefore, I think there will be a better case for calculation of refund in case of inverted duty structure. We also need to bear in mind that over a period of time, because of realignment of tax rates, the situations of inverted duty structure are going to reduce day in and day out. More importantly, keep in mind the caveat that taxes on input services and capital goods are still not eligible for refund in case of inverted duty structure. Of course, another clarification has been issued to clarify that if I'm buying some product at a normal rate, and then if I'm selling to, let's say, defense or to scientific institution under a concessional tax rate end use based notification, then this would be treated as an inverted duty structure and I would be eligible for a refund in those situations. This is an interesting clarification which has been issued in the context of fake invoicing. And before I really go into explaining these three situations, it's very important to understand that what do we mean by a fake invoice. And this is something wherein it's going to be the word of the taxpayer against the word of the investigating officer, and also at times against the word of the customer or the supplier. And each situation can be a very specific type of a situation. And post the consummation of a transaction, in many cases, it can be very difficult to really pinpoint a situation. Now, how does the government look at this? It says a fake invoice is a situation where a person issues an invoice, but there are no underlying goods or services. So I'm just issuing an invoice. I'm getting the money in check. Maybe I'm giving back the money in cash. So there is no underlying supply of goods or services. And we have had a lot of investigation, arrests, etc. happening on this front. And in fact, in many cases, this has resulted in a lot of pain, especially if there's an entire chain of transactions. Let's say A sells goods to B sells goods to C sells goods to D, and the goods are directly delivered by A to D. In this case, can we say that A to B, B to C, and C to D are transactions without underlying supply of goods? My answer is clearly no, you cannot say so. There are underlying goods. What would be the situation if after A sells to B, B to C, C to D, D again sells goods to A, and therefore the goods which are lying in the warehouse of A do not require any movement from A to B, etc., etc., in the entire chain. I would believe here also there are underlying goods or services, and there is a constructive delivery of goods by way of transfer of a document of title in the goods, which is an LR, or which could be a delivery note, or it could be an invoice also. These are not situations of fake invoicing. A situation of fake invoicing will be a situation where a person really does not have any goods at all and he issues an invoice. Now, it's going to be very, very difficult to really establish these types of situations in a practical parlance. But yes, the department would want to extend this phrase to even the earlier examples. And in those situations, the question comes up is who can be penalized and how? So the circular talks about three situations and gives some guidance on this front. What it says is the first situation is a situation where a supplier issues a fake invoice without underlying supply of goods or services. So this is from the seller's perspective. So the sale is a fake invoice. Make no mistake, his purchase is genuine, but the purchase lies in his stock and somebody wanted an invoice, so he just gave an invoice. In this case, the circular clarifies that this supplier, he has actually paid a tax where he was not required to pay anything. So if he has paid a tax where there was no requirement to pay, you can't issue him a show cause notice for underpayment of tax. So that's what the circular clarifies. It says no show cause notice can be issued under 73 or 74, since in this case no tax was paid. But it says penalty under section 122 can definitely be imposed because he is issuing an invoice without any underlying supply of goods or services. Of course, what is the quantum of the penalty can be a debate over there, whether it's going to be 10,000 arbitrary, or because it says 10,000 or tax evaded, whichever is higher. Admittedly, there is no tax evasion, so one would believe that it has to be 10,000, but this is something which is going to be a subject matter of interpretation. Now comes the second scenario, that a person purchases are invalid or non-genuine. So a recipient accounts for a fake invoice, but his corresponding outward supply is genuine, which means he has some goods which are unaccounted stock. He takes an invoice for this transaction where he does not get the goods and he already had those goods, so he's selling those goods. So the outward supply is genuine. In this case, naturally, this is typically done for profit adjustments. And in these types of situation, the circular says that, look, you did not receive the goods, you claimed a reduction in your profits, you saved income tax. Same way you claim the GST credit, which is not available to you, and therefore you are liable to reverse this input tax credit, and show cause notice can be issued under section 74. Once 74 proceedings are initiated, no action under 122. So it's either or is what the circular tries to clarify, and which is right. It then goes into a third scenario, and this is a very interesting scenario. It's about a person who takes a false purchase invoice. He has not bought any goods. He just took an invoice from somebody. He did not have any goods at all. And after taking this invoice, he issues a false invoice to somebody else. So his purchase is also wrong. His sales is also wrong. Both the legs are fake. The circular clarifies that in this situation, because there was no underlying goods or no underlying supply, no show cause notice under 73 or 74 can be issued, just like case number 1. But penalties under 122(1) subclause 2 dealing with the purchase side and subclause 7 dealing with the sales side can definitely be issued. And then the circular ends with a caution that in specific cases, prosecution under section 132 can also be initiated. So all in all, what this circular tries to bring out is that the show cause under 74 can be issued to a person who genuinely does not get the goods, but only gets an invoice. And he tries to inflate his input tax credit and reduce his output tax credit by putting in these types of fake invoices. So in a way, all in all, a reasonably good clarification, but how are we going to implement it? Because these are all very subjective aspects which one needs to bear in mind. And finally, on the limitation front, because of the pandemic, there was a Supreme Court ruling which said that a period from 1st March 2020 to 28th of February 2022 should be excluded for the calculation of limitation time barring for the purposes of filing of refund claims. So this has been respected over here, and we now have a very specific provision to that effect. Naturally, if you are getting time for filing refund claims, even the department should get time for issuing show cause notice or order in original if the refund is erroneous. So both those provisions are being brought into place. And finally, on account of pandemic, we are told that the time period for issuing an order in original for financial year 17-18 in normal situations is extended till 30th of September 2023. Please note, this is for normal situations not involving a intention to evade a tax. In case of where the normal period was 3 years, this has been extended. In case of fraud, intention to evade, etc., the normal period itself is 5 years. So that is what we need to keep in mind. And therefore, the department would have some more time for investigations for 17-18. So with that, I think these are some of the major points from my side, which I thought were relevant. I would like to thank each of you. I am aware that we have extended the time limit slightly. But yes, the topic was a little bit detailed, so we had to take it through this time frame. If there are questions, we can take a couple of questions from the participants. So you can put it in your chat box, or you can unmute yourself and put those questions. In the meantime, I would like to request you to go through all our communications in form of newsletters. We have been of late, we have been very regular in sending you all these communications, and I hope all of you are on the WhatsApp groups and on the email mailing lists. And it's time to come back out from the pandemic hibernation. And department has already come back, and we are seeing a barrage of notices and investigations and queries coming from the department front. And it's time for us as tax implementers also to really take it in the right spirit and push up our ante to make sure that we are compliant. I will wait for a minute if there is any question. Okay, no questions means either everything is understood or everything is not understood. I assume it's not the second one. Yeah, I think Sanjay Chaturvedi has one question. It's relating to RCM on ocean freight on import of goods on CIF basis. We are aware of the Mohit Minerals decision. Clearly, because of the Mohit Minerals decision, there is no requirement to pay any GST on the CIF value of imports. I think that's very clear. There is a question of whether there can the PPT can be shared. Yes, we will share it on the WhatsApp group, and you can use it later. I think those are the queries. Thank you very much for participating and
सर मेरा एक क्वेश्चन था.
हाँ जी
सर CIF जब इंपोर्ट आएगा इट मींस कि फ्रेट प्रीपेड हो जाएगा डेस्टिनेशन पे. जब इंपोर्ट फ्रेट प्रीपेड हो जाएगा डेस्टिनेशन पे तो ऑटोमेटिक RCM नहीं आएगा.
Yes, that is what the Supreme Court ने अभी लिया है. पहले गवर्नमेंट ने 10% का नोशनल रूल निकाला था. वो नोशनल रूल को अनकॉन्स्टिट्यूशनल बोला है गवर्नमेंट ने. So basically, what you are saying is right. There is no question of paying any GST on this. There was a long battle, and ultimately the battle has been won. So as of today, we can just conclude by saying that there is no GST on that.
क्योंकि सर हम लोग जो भी इंपोर्ट फ्रेट पे RCM पे करते हैं वो तब पे करते हैं जब हम ओवरसीज एजेंट को पे करते हैं. जब हम
I agree with you totally. Long and short of it, yes, if you pay freight, you have to pay GST. If it's a part of CIF value, you don't have to pay.
मतलब ये जजमेंट का मतलब सर मेरे हिसाब से कोई मतलब नहीं हुआ जब फ्रेट है ही नहीं, फ्रेट का कोई ट्रांजैक्शन ही नहीं हो रहा है.
तो फिर 15 दिन पहले आया जीवन जी. 15 दिन पहले सब लोगों के लिए मतलब था क्योंकि सबको शोकोज नोटिस आता था, डिपार्टमेंट का हैरेसमेंट होता था. अभी जजमेंट आया है, इसीलिए आई थिंक थिंग्स आर वेरी क्लियर.
लेकिन सर सो कुछ नोटिस कैसे आएगा जब इंपोर्ट फ्रेट का ट्रांजैक्शन हो ही नहीं रहा है. यहाँ पे कंसाइनी भी फ्रेट पे नहीं कर रहा है. ऑलरेडी फ्रेट प्रीपेड हो गया डेस्टिनेशन पे ही. फ्रेट ट्रांजैक्शन हुआ नहीं. हमने सिर्फ लाइन को लोकल चार्जेस पे किया और डिलीवरी ऑर्डर कलेक्ट किए. तो इंडिया में तो फ्रेट ट्रांजैक्शन कुछ भी नहीं हुआ बुक्स में.
सर आया था लोगों को, लेकिन अभी मैटर सॉल्व हो गया है. तो आई डोंट थिंक वी शुड गो इनटू टू मच डिटेलिंग.
ठीक है सर.
ओके, आई थिंक एनी अदर क्वेश्चंस वी कैन टेक. Okay, thank you very much, and we'll stay in touch. Thank you.